Hi, friends. We've continued this bumpy stretch in the markets, and if you've been feeling uncertain or disappointed, you're not alone. After weeks of chop and retracement, it's clear that this is one of those moments where being an investor requires both patience and presence. It's easy to second guess your strategies when prices don't move the way you expect, but this is exactly when our mindset and skill development matter most. In this issue, I'm sharing some hard earned lessons from my recent options trades, why I'm shifting away from strategies that rely on daily attention, and how I'm approaching shorting as a way to learn and earn in uncertain times. You'll also get a look at what's happening in the crypto and DeFi world and why I'm still playing the long game with those positions, even as many altcoins are still deep in the red. Plus, we'll take a deeper dive into three core investor skills: shorting, hedging, and using leverage wisely. Let's go. Options trading. Why I'm shifting away. Well, the volatility since mid January hasn't let up, and unfortunately, neither have the losses on my options trades. My iron butterfly positions have all hit their expiration at maximum loss. Fortunately, the butterfly structure capped my losses at $109 on the possible $497 gain I was looking for. Small comfort, but valuable protection. I'm still holding two SPY positions, a put and a call. The put is edging back toward break even as markets remain soft, but the call, which I opened just before the drop, is deep in the red. I've tried dollar cost averaging to reduce the cost basis, but it will require a market recovery before June for that trade to work out. Something immensely positive would have to occur. Now that the Fed has held rates steady again, there's less uncertainty, but also less fuel to drive markets higher. With no new liquidity and tariff talk already priced in, we're likely to drift sideways until at least the next Fed meeting in June. And that's a problem. These SPY options were designed for movement. If we stay stuck in this range, neither trade will play out well. My put, expiring December 2025, has time, but the call, expiring June 30th, likely won't recover in time. Instead of hedging my hedge, I may have unintentionally doubled down on risk. The learning continues both in real time and in workshops. I attended the Rose Tree Bootcamp last weekend, and it helped me put things into perspective. I finally understood the real difference between hedging and shorting. They have two very different objectives that require very different setups and expectations. Even with tools like OptionStrat to calculate outcomes, if you don't fully understand how to apply the strategy, the odds are stacked against you. Here's what has been confirmed for me. Options aren't just about direction. They're also a battle against time decay. Every day a position goes against you, you're locked into a worse return. And if, like me, you only have a couple days a week to manage your trades, this can get away from you quickly. The most important lesson is to know yourself, your constraints, and your tolerances. It's been fun building knowledge with options, but as we come closer to the end of this bull market, I need to have strategies that will work for me to capture the turn in the markets. So it's time to pivot. Rather than trying to outpace the decay, I'm shifting towards strategies that reward patience. I'll be building skills in shorting with low or no leverage and letting time work in my favor for the time being. Shorting as a winning strategy. Let's talk about shorting because it's one of the most misunderstood and underutilized tools in personal investing. We've been taught for generations that markets go up and that's how you win. But what if they go down? Is that always a loss? Not if you know how to short. Here's the basic idea. When you short a stock, you sell it first, effectively borrowing it from your broker, then buy it back later at a lower price. The difference between what you sold it for and what you buy it back for is your profit. It's the exact opposite of a traditional buy low, sell high model. In shorting, it's sell high, buy low. As you can see, the actions are the same, just in an opposite sequence. The best part is the risk isn't in the direction. It's in leverage, liquidation events. The horror stories you hear come from over-leveraged positions, not the act of shorting itself. In fact, shorting without leverage is one of the safest ways to play a falling market. You can wait for the trend to unfold and your gains increase the further the prices drop, just like a long-term buy and hold, but in reverse. Here's another insight. When we trade, the underlying assets aren't actually changing hands. What's really happening is a transfer of money. One side gains, the other loses when the position is closed. If we take a long position, we give money to the brokerage to control the asset. And when we sell, they return our money along with any gain or loss. Shorting works the same way in reverse. The brokerage deposits money into our account based on the current value of the asset, and when we close the position, we give that money back, keeping the difference if the price dropped or covering the shortfall if it rose. This mindset shift is powerful. It teaches us that market direction isn't good or bad. It's just a trend. If we can identify the trend, we can profit from it, regardless of whether prices are going up or down. Right now, I don't believe we've hit the top of the market cycle yet. Too many analysts are calling for a collapse. That's not the psychology of a peak. True tops come when nobody wants to believe a correction is coming, not when everyone's waiting for it. So in the meantime, I'm practicing shorting with small positions on assets I understand well, like utility stocks that move opposite tech. It's a great way to build the skill while markets move sideways. I'll keep you posted in the next issue. DeFi update, crypto resets, and yield strategy. Let's shift gears to DeFi. While the broader crypto market has taken a hit, and altcoins especially have suffered, my concentrated liquidity positions are still working. They're generating yield even though the total portfolio value is down due to price drops in the underlying tokens. This is the long game. One of the reasons I love DeFi is that it doesn't punish you for time. Unlike options, there's no expiration date. You can hold your position and let it work, earning passive rewards until the next bull run. That said, the crypto landscape is evolving fast. New projects are launching weekly, bringing innovative solutions and fresh opportunities to the DeFi ecosystem. Legacy protocols are expanding into vertical services, incorporating their own blockchains, exchanges, lending, derivatives, and applications, making the space more competitive and mature. They won't all survive, but the technology and value cases will become stronger, and the future winners will become visible. Traditional finance is stepping in, thanks to favorable government sentiment and movement in regulatory expectations that can provide more stability to the asset class. New Layer 1 chains are gaining traction, reducing fees and increasing transaction speed, providing an infrastructure for digitizing assets. The idea of digitizing securities, treasuries, and bonds is one of the most exciting directions in finance today and will lead to digitizing other hard assets as the technology matures. While all this growth is exciting, it doesn't help my current positions much, at least not yet. I'm still holding through the downtrend, waiting for the fundamentals of these tokens to catch up with the enthusiasm building behind the scenes. We are not yet at the end of this cycle, so I will continue staying in positions that are earning yield and monitor new trends by staying engaged with the Beacon community. When altcoins recover, I'll exit all positions into stablecoins in preparation for reinvesting at the bottom of the crypto bear market in 2026. Markets are tough. They spend a lot of time going nowhere, but portfolio growth continues when you have a plan for your positions and are patient to let them play out. Investor Skills Corner. In this issue, we're focusing on three foundational but often misunderstood investing concepts: shorting, hedging, and leverage. Not just tactics, they reflect how you think about risk, opportunity, and time. The better you understand them, the more intentional and flexible your portfolio becomes. Shorting, seeing the market in reverse. Shorting challenges one of the most deeply held assumptions in investing. That down is bad. It isn't about being negative or pessimistic. It's about understanding that markets move in cycles and that downward cycles can be just as profitable and often faster than upward ones if you're positioned to take advantage of them. The mindset shift comes from letting go of the emotional bias that says loss equals failure. When you short well, you're not betting against the market. You're aligning with the natural retracement that comes after excess. To short successfully, you have to think in terms of momentum shifts, not just price targets. Stay emotionally neutral because celebrating drops is just as dangerous as panicking during them. Greed and fear apply regardless of the direction. Build patience. Shorting isn't about timing the exact top or bottom any more than when investing long. It's about recognizing when a trend changes and staying with it as long as it runs. Shorting works best when technicals are paired with fundamentals. If you know why an asset is overvalued or overextended and you're not using leverage that can trigger liquidation, you have the freedom to let the market come to you. Hedging, protecting what you've already built. Hedging isn't about winning. It's about not losing everything. Think of it like wearing a seatbelt. It doesn't get you to your destination faster, but it helps you walk away when the road gets rough. Effective hedging requires more than just a defensive mindset. It starts with a clear understanding of your risk exposure. That means you need to ask, what portion of my portfolio is vulnerable to a downturn? How much of a drop am I willing to absorb? What would it cost to offset that risk? For example, if you have a $100,000 portfolio and you're concerned about a 20% drop in the next year, a basic hedge might aim to earn $20,000 if that scenario plays out, keeping the overall portfolio even. The next step is choosing how to express that hedge. It can be implemented through inverse ETFs, strategic shorts, or concentrated trades in assets that move opposite your core holdings. The key principle is proportionality. A hedge doesn't erase all downside. It's designed to limit damage to an acceptable level based on your time horizon and goals. And like insurance, the cost of that protection must be factored into your overall return expectations. One common approach is to set a position that costs 3% of your portfolio per year. It covers any minor 10 to 20% corrections and gives time to reposition the portfolio if a deeper drop, 30 to 50%, occurs. The strategy works because it maintains the protection while also recognizing that markets rarely experience the full drop in one day. Think of it as buying time to breathe before reacting. Most importantly, a hedge is not a bet. It's a line of defense structured to be worth having, even if it never pays out. If you can accept that mindset, you'll never feel like you wasted money when your hedge loses value, because that loss means the rest of your portfolio is likely doing just fine. For example, a loss on my Bitcoin hedge means my Bitcoin holding is going up. If it turns and goes down, the hedge position is now rising. Either way, the two positions remain in balance. Leverage, power that cuts both ways. Leverage is simple in theory. You borrow money or use instruments like options to control more capital than you actually have. This magnifies both your gains and your losses, and it compresses the timeline of your outcomes. In the crypto world, you would use a DeFi exchange with perpetual features to trade on crypto assets. In the stock market, leverage is added to your account as margin with current assets as collateral. Most large brokers will require you to request margin for your account, while online brokers often include it automatically when you deposit a minimum balance of cash to the account. Used responsibly, leverage can be a powerful amplifier, but it requires precision, knowing both how much to risk and how long to hold, what your exit signals are, and what your worst case scenario looks like in dollar terms. Just as with options, exit failing positions as soon as possible. This is the safest strategy for using leverage. Tight stop losses will do this automatically, but can cause being stopped out quite frequently, so knowing how to apply stop losses is a skill of its own. Most importantly, never let leverage drive your thinking. Use it only when your conviction is high, your timing is tight, and your risk is capped.